By way of introduction, as you all know, Zoltán Pozsár is investment strategist at Credit Suisse based in New York. He was formerly at the US Treasury Department and is also a founding member of the INET Colloquium on Shadow. And just like last time, we'll have Professor Christoph Becker, who will be interviewing Zoltán. And so Professor Becker is a professor in financial mathematics at the Darmstadt University of Applied Sciences. And his particular interest is in the stability of the shadow banking system, particularly the empirical investigation of liquidity risk. And so just like last year, we will have about 35 to 40 minutes with Christoph and Zoltán. Thereafter, we'll open it up for Q&A from the audience. You're welcome to either post questions in the chat, and I'll do my best to keep track of them. But as I remember last year, there were numerous questions, and so let's see how we do. At the end, you can also notify me and let me know if at the end you want to ask your question directly to Zoltán. So just keep track of that. But for now, I'll hand over to Christoph, who will give a more in-depth introduction of Zoltán and carry on with the interview. Thank you.
Okay, so I shall say a few words about Zoltán. Is that right? Okay, I think everybody, probably most people know who Zoltán is. For me, Zoltán is the most important practitioner that I know who actively uses the money view language, and his money notes are my personal best source of information on developments in the financial system, apart from reading the Financial Times. Well, this is it. Yeah. Good. Zoltán, I've listened to your interview at Bloomberg in March, and there you said, if I understood you correctly, that we should not redesign the treasury market just because there is occasional volatility, because as long as there's a value investor that limits market moves, then markets are fine, more or less, and it's a healthy thing to see occasional volatility. Now, I hope this is correct. I'm probably not alone when I say I'm not so sure about this, and therefore I thought we start with a discussion about dealer stability. And I'd like to look at it from three different angles. So the first thing is, for me, financial markets grow, and specifically government bond markets grow, but the balance sheets of dealer banks stagnate, say about since 2010. The danger is at some point that the capacity, say the size of the inventory of dealers, becomes too small relative to markets. So there's Darrell Duffy, he suggests to introduce central clearing for the treasury market, etc., etc. But I must admit, I do not see why central clearing should really help when, say, trading flows are extremely one-sided. So my question to you, my first question is, what do you think? Shouldn't we generally increase the capacity of dealers, or say specifically the inventories, in proportion to the growth of, say, bond markets?
Well, that's a good question. Okay, can you hear me, by the way?
Yes.
Yeah, you're fine. So look, that's a good question. I tend to agree with you that central clearing is it's not the solution to any of this. Simply because as you have said, markets sometimes get one-sided, and then no amount of central clearing can handle that. I mean, look, if you and I've seen also charts about dealer inventories of treasuries not growing really with the supply of bonds, but then I'm somehow kind of thrown off by those charts, simply because you show that relative to, I don't know, pre-2008 or something like that, these inventories have shrunk, yet bond supply has increased. But also, I think the other thing to keep in mind is that, whereas before the crisis, bonds were the dominant asset on dealer balance sheets because cash in the system was so little, people often tend to forget that looking at these bond inventory charts in isolation is a bit misleading, simply because when you look at the universe of safe assets, it used to be bonds only pre-08, and today it's bonds and a ton of cash. It's all the central bank reserves that are in the system, and basically, a lot of bonds have been monetized, and so the bulk of, money dealing activity that goes on through dealer balance sheets these days is done number one in the FX swap market. And, you know, there's no numbers to track, you know, the inventory positions of dealers in FX swaps, you know. So when you kind of look at, you know, bonds are not as big as they were. I mean, you know, if you were to look at the inventories that the dealers run in the FX swap market, those would be much bigger. So this is a little bit of a perception problem where we measure one thing and we look at it, it's either stagnant or falling when bond supply is growing. But then what we also know, and I always talk about this in, you know, on odd lots or every time I talk to you guys, you know, the FX swap market it's hugely important these days, way more important than it has been pre-2008 and pre the whole Basel III era. And, you know, I just mentioned this because a lot of the bonds in the system that have been placed and are being held are financed through the FX swap market. And so that's just a big buy and hold investor base. So that's maybe one set of observations. The other set would be, again, you know, what happened in late February when we had that volatility in the bond market. Again, you know, like people's perception of the world and this whole idea that the Fed is never going to hike completely changed, right? Because we started to have the vaccinations getting rolled out quickly. Then, you know, in December, we had the blue wave. You know, the administration has been quite active on the fiscal front, right? So there's a lot of supply coming. There's a lot of stimulus coming. There's a lot of vaccinations are happening. And so, you know, the world is quickly getting back to normal. And so the market completely repriced the inflation outlook and the Fed's reaction function to that. And basically a very popular trade, which was, you know, being long the 5-year and short the 30-year part of the curve, just completely gone out of the window. And so it was a crowded trade and the system needed to get out of it quickly and en masse, you know, as the perceptions of the future have changed. And so, you know, the market had a little digestion problem to do that. But again, do we need to redesign anything to make sure that the system can get out of crowded positions with less pain? I really don't think so. And by the way, like on normal days, you know, the dealer community can handle whatever liquidity has to occur in the treasury market. I mean, obviously March of 2020 was a once in 100-year event. So, you know, no amount of planning is ever going to be able to design a system where dealers can handle those types of flows. I mean, you know, the central bank had to step in back then. But I guess what happened in February, that's just perfectly normal. It's a lot of kind of trades in the system that accumulated without people actually thinking around the risks of those. And so I really don't think that we need to redesign anything here. The third thing I will say about that about all this is that obviously we have this related issue that I have been writing about, which is that you know, the dealers have been running with a fixed quantum of capital ever since Basel III was rolled out, and so. You know, when you look at the CET1 capital base, this is the common equity tier 1 capital of the dealer, of the GSIBs, basically, that are the most important market makers in the treasury market. That's been flat. And then since the pandemic, there was this improvement in that capital position because there was a ban on stock buybacks. And so that increase in capital basically increased the bank's ability to warehouse treasuries in their portfolios. But again, that's not a market making function either. So, you know, I guess my conclusion there would be when you look at the day-to-day functioning of the system and the amount of trading that needs to occur, I think, the system has enough capital for it. I mean, most days are fine in the treasury market. And then when you have bottlenecks, you have bottlenecks. But, whatever happened in February, the system digested it fine. I mean, prices were pushed around, but the system digested those pressures fine.
Okay. You talk about equity. I think about the SLR, the leverage ratio discussion.
Yeah.
So let me jump to the SLR. I understand from your publications that the SLR at the moment doesn't limit the capacity of dealer banks. That's fine.
Yeah.
But I've read something from Daryl Duffy, and he argues that the SLR distorts market making due to something he calls funding value adjustments. So for those who are not aware of this, let me briefly explain the idea. Suppose a dealer buys treasuries worth 100, and then he funds it with 95 credit, say repo, and 5 is additional equity, because that equity is required by the SLR. The problem now is that the treasuries by definition do not default. So the $5 equity actually serves as an additional risk buffer for the remaining debt of the dealer. And therefore the market price of the dealer's outstanding debt goes up and the value of the dealer's equity goes down, simply because equity is a residual quantity. In other words, if I understand this correctly, the SLR creates a strange effect that absorbing the trading flow in treasuries effectively shrinks the value of the dealer's equity, and therefore it's not a surprise that dealers might hesitate to absorb additional trading flow. The inventory position becomes somewhat sticky, we could say, or the dealer increases the bid-ask spread to compensate for his loss in equity. So what do you think? Isn't all that a clear conceptual argument that the SLR should be abandoned in principle?
Well, I definitely don't think that it should be abandoned in principle. I think, okay, we live with an accord called Basel III, and Basel III, I think, is as I always said, it's a very well designed something. It's a very robust regulatory framework. It has its 4 building blocks, more and higher quality capital to absorb losses, liquidity buffer, a leverage ratio, which kind of serves as a backstop to how big a bank's balance sheet can grow relative to capital, requirements for stable funding, the GSIB scoring is also a part of it. So, I think it's well designed. It's putting the individual banks and the banking system into a much more, the financial system is a lot safer for it. So now we ended up in a position where liquidity in the financial system has expanded dramatically, partly because the Fed did QE. And so, the banking system is basically at a spot where, look, our deposits and at the Fed and our deposit base have expanded. This came out of nowhere. And so for us to be able to take all this liquidity on, we need to have reserves and maybe treasuries, but reserves for sure, be exempted from the leverage ratio, such that the leverage ratio is not binding. Okay, and so what do you do in response to that? Well, one school of thought, I guess, that we heard about earlier is, let's just get rid of SLR altogether, or maybe exempt reserves from the calculation of the supplementary leverage ratio. Some have that view. There is also the other view, which is, it has always been the case that versus liquid assets, reserves and treasuries and the whole HQLA portfolio of a bank, you need to hold X amount of capital, and it is what it is. It's the rule. So you could basically do what the Fed did during the pandemic, which is, you ban stock buybacks, which is another way of saying you just ban capital return to shareholders, and you basically force the banks to retain the income that they generate, and through those retained earnings, the bank's capital base is just going to increase, and that increased capital base is what's going to make the SLR not binding, right? Because if the issue is that the quantum of assets that the banking system has expanded faster than the capital base has, over time the capital base is going to grow into that larger asset base, and so these are basically the two solutions. So the two camps out there are make big changes to the way the SLR is calculated, and then the other school of thought is just have the banks retain more income, return less capital to shareholders. I would also say back in 2015 we were also in a situation where the SLR was binding. But 2015 is when Basel III was rolled out, and so back then, just when you're rolling out Basel III, once the constraints showed up, the response wasn't let's change Basel III and let's not adapt it. The banks were basically forced to adapt, and there were some large banks in the system that basically had to turn away some non-operating deposits to make sure that they are compliant with the SLR. Similarly, there's always constraints in the system, whether it's a GSIB constraint or whether it's a other capital constraint or whatnot. So, the nature of Basel III is that it's putting all these constraints in the system, and then the banks will have to make tough decisions to kind of make these constraints go away. So going back to this idea of what do you do with this SLR constraint? Again, I just don't think that. First of all, I think people make the mistake in assuming that the system, the financial system, is the GSIBs. The financial system is not just the GSIBs. The GSIBs are very important parts of the financial system. You could say that they're the biggest and the most important parts, but they are just cogs in a broader system. So, the one again, and I keep on harping on reserves, not treasuries, because the expansion that we fed in the system came from reserves, and that's causing these SLR bottlenecks at the moment that then have kind of spillover implications for the treasury market. But the way I think about this imaginary constraint in the system when it comes to who is going to absorb all the reserves that the Fed has put into the system, and who is going to take on all the deposits that are getting pumped into the system with the stimulus checks. But the GSIBs are going to take on a lot of it, and they have. But then below the GSIBs, there is 20 large regional banks in the U.S. Few of you probably know, but PNC Bank, which is based in Pittsburgh, has taken on more than $400 billion of deposits during the pandemic. In terms of how much deposits PNC Bank took on. PNC Bank took on more deposits and more reserves at the Fed than Citibank and Bank of America, just for context. And then other than PNC Bank, there's a bunch of other banks, U.S. banks and Citizens Bank and Regions Bank. And, these are the called regional and super regional banks in the U.S. So what's happening now that, the Treasury's cash balances are coming down and another round of stimulus has gone out, is you can see two things. These regional banks are taking on large amounts of deposits, just as they have last year, but the regional banks don't have any SLR constraints, because their ratios are, PNC's bank SLR is 9%. So practically they don't really have a limit to how much deposits they can take on. So one thing that's going to come out of this is that there will be kind of a convergence between the regional and super regional banks and the big US G-SIBs. You know, the regional and super regionals are going to become more national in size. You know, and some of these banks are doing mergers as we speak. You know, PNC, for example, purchased BBVA. And so, you know, so there's going to be that convergence. If the large banks can't take any more deposits, the deposits are going to go elsewhere. So the regional banks are going to get bigger. The second thing that's going to happen is that if the US G-SIBs cannot take any more deposits, then more of these deposits are going to go to all the New York branches of foreign banks. And so if you think back at the 2015 to 2016 era, you know, there the you know, QE1 to QE3, when the Fed pumped in all the liquidity into the system through those QE episodes, you know, half of the liquidity went to the American banks and the other half went to the foreign banks. And a lot of that liquidity went to foreign banks simply because the American banks were balance sheet constrained and that they just couldn't take on more deposits. And again, we are getting into a situation like that again. I mean, if you look at money fund flows, for example, you see this amazing increase in institutional class money fund shares over the past month. I mean, you know, those inflows have reached close to 300 billion in just a month, simply because as all the money is coming in from the stimulus, the big banks can't take it anymore. So all the money is going to the money funds, and then the money funds are lending it to the foreign banks. So that's the second group of banks that's going to absorb all the excess liquidity, and then you know, the mother of all shock absorbers, the reverse repo facility, is also there. And the usage of that facility is going higher too. So, you know, the reverse repo facility is always going to be the facility that's going to take all the excess liquidity that, you know, nobody has a bid for, and that facility is going to absorb that liquidity. So why do I say all this? I say all this because, again, this SLR constraint is in a way, you know, imaginary, right? Because, I mean, no one is forcing these banks to take the liquidity on that the Fed is putting into the system. It's a business decision as to whether you want to keep it on your balance sheet, or if at the end of the day you want to deflect these deposits away by slapping a negative interest rate on them, or slapping a fee on them, or you just, you know, pick up a phone and ask a corporate treasurer to please move your money from the bank to the asset management arm of the bank, where it's in a money fund, and so in a money fund it doesn't use balance sheet for the bank. So these are all business decisions. Now, when it comes to this market making in the treasury market and the SLR constraint there, again, you're a primary dealer. And if you happen to be an American bank and you're a primary dealer, there is such a thing called the Primary Dealer Act, you know, which says that, you know, you just have to be present at auctions and you have to be making markets. I mean, an American bank is always going to be the most important market maker in treasuries. And so, you know, these banks know that, right? So you will want to preserve your ability to make markets in the treasury market at all costs, you know, return targets notwithstanding. And you will just make adjustments elsewhere on the bank, maybe in terms of how much deposits you take and what kind of deposits you take to kind of make room for market making in the treasury market. So again, just because you hit a limit, it doesn't mean that you need to get rid of that limit and that constraint. You know, the constraints are there for the system to kind of manage around, and there's many avenues in the system through which these constraints can be resolved. You know, it's and I'll just say one more thing. You know, the same thing with the G-SIB constraints, for example. That, you know, some people are going to say that we not only need to change, you know, SLR, we also need to change the G-SIB scores. Well, you know, the G-SIB scoring is doing precisely what it was designed to do. I mean, G-SIB's idea is to deal with too big to fail, right? So if, you know, one particular bank were to kind of push up against the G-SIB constraint, well, that's kind of a signal, according to the G-SIB methodology, that one bank is probably too big, too interconnected, too complex, too whatever. So you just can't grow anymore, because if you do, then, your cost of balance sheet gets way more expensive relative to everybody else. And so that's maybe a limit to how much you should be growing. But then that's an opportunity for all the other banks that are not nearly as high on the GSIB score. And so, that's how the playing field gets level. But again, I just wouldn't jump to the conclusion straight away that just because we have a constraint, the solution is to make all these big wholesale adjustments to SLR and how we calculate it and the social benefit of these ratios.
I see, but something that still puzzles me, I must admit it.
Yes.
Isn't the SLR regulating the wrong risk in dealers? I mean, what you find on the balance sheet is repos in and repos out. So the relevant risk is actually liquidity risk, not solvency risk. And liquidity risk in the sense that the dealer's business model relies on a functioning repo market. That's it. So isn't the trouble with the leverage ratio actually a good example that regulators overestimate the importance of default risk at the cost of liquidity risk? Isn't that actually true?
You're saying the two risks you mentioned were what? Liquidity risk and default
solvency risk. Yeah, default risk, solvency risk. Yeah, and
no,
the SLR
I mean, look,
protects you. Okay.
Yeah. So look, the SLR was put in place as a as a backstop binding measure, right? I mean, you guys know what goes into the calculation of the SLR. It's basically total on-balance sheet, the average of total on-balance sheet assets plus off-balance sheet derivatives and securities financing transactions. So it's just a non-risk rated measure to limit the size of balance sheets. Now, when it comes to the actual application of the SLR, I mean, there is the holding company SLR, and then there's the bank level SLR. The way that the dealer gets captured in all this is, the dealer is a part of the holding company, and so that's that. And sure, a dealer is going to have a lot of matched repos. I mean, some banks are going to book those repo books in the bank, actually, not the dealer. So things can get complicated that way. But again, it's a little bit like, are we sacrificing liquidity risk? I just wouldn't jump to the conclusion that the reason why March happened is because the SLR wasn't extended. I mean, just for context, all that you're saying is really for the system to be compliant with the SLR again, all you would have to do is not buy back stock for a year, and that's precisely what the system has done, and that's precisely why nothing happened when the SLR exemption went away on March 31st. And so, I guess the other angle to this is that if you think about it, right, an economy always grows over time, and in a growing economy, the banking system is going to grow over time. And so, if the banking system grows over time, your liabilities and your deposits and all that stuff is going to increase over time. And so, if you have more liabilities, you need to carry a greater quantum of HQLA. And to accommodate for that greater quantum of HQLA, you will have to have more capital anyway. So basically what you see now is that we've had this massive acceleration of HQLA growth that was kind of brought forward in time. And so again, the two paths forward is, how do we deal with this? Do we kind of force the banks to hold more capital to accommodate the surge in safe and liquid assets, or do we exempt some of these assets from the calculation of the SLR, as as kind of ways to deal with these constraints. And again, I think that's basically the fundamental question. I'm not sure that redesigning Basel III is necessarily the right approach there. Number one. Number two. Again, when you look at the list of primary dealers, there is 20 of them, 20 plus. The American dealers are big and important, but if you have constraints at the American dealers, you have all the Yankee dealers out there that do not have the same constraints. None of the Japanese or Canadian or French or Swiss dealers have the types of balance sheet constraints that the Americans do, because, they did not take part in absorbing all these deposits that the Fed has put into the system, simply because they don't have reserve accounts at the Fed. And so then again, you have activity that will shift from the American dealers to the other dealers. And so, when you look at financial cycles and the way the system operates, I mean, there's all these ebbs and flows between who intermediates and who holds the liquidity. And this pendulum is always swinging between American and foreign dealers. And again, we were in a similar situation back in 2015 and 2016. It's just that Basel III was getting rolled out at that time. And so the initial response could not be, let's just change a big part of this thing that we are trying to apply in the system. But now, those views are probably a bit more prominent this time around. It's going to be up to a regulator that's going to make, the decisions on this. But I think the fact that the Fed didn't extend the SLR exemption probably tells you that the Fed is thinking about a lot of the same questions, and this is not an easy decision.
Okay, Zoltán, I have two questions left, but Christina will only allow me to ask one. So one about CCPs, one about crypto. So CCPs and central clearing. So CCPs solve the problem of interconnectedness. I understand this, and they eliminate counterparty solvency risk, and that's a good thing. But CCPs are private companies, and the way they eliminate solvency risk is to adapt margin requirements over time, and in a crisis drastically. Yeah. So as I understand it, CCPs actually just convert solvency risk into liquidity risk, and CCPs convert a risk that is extensively studied, solvency risk, and easy to manage, into risk that is much less well understood, liquidity risk, and very difficult to measure, and therefore difficult to manage. My first question is, do you agree?
I do. I mean, again, I think any CCP question needs to have a very robust liquidity backstop, right? And I think, I mean, I don't actively look at the CCP topic very much in my current role, but I think that's still probably the big missing link in terms of, we're going to put everything into CCPs and we're going to centrally clear everything, and so everything is going to be in one place. And that one place is going to be extremely important systemically. I mean, it's not that it's going to be a foolproof way of dealing with things. And number one, number two, the liquidity backstop there is going to be essential. And as far as I know, none of the CCPs have access to central bank liquidity facilities as of yet. So. That's what I would say to that. I'm not sure if that's a satisfying answer or whether you asked that. Is that what you asked? Or
yeah, that's fine. I just wanted to hear your general impression about CCPs.
Yeah.
Christina, one very quick last question about cryptos. So to be honest, 1 year ago, I still thought that cryptocurrencies are just crazy. But now central banks think about introducing CBDCs, so I must change my mind. So from a money view perspective, many questions come up. Where in the hierarchy of money and credit should we place a private cryptocurrency? Is there a dealer system evolving, etc., etc.? So my question, do you actually closely follow developments about cryptocurrencies or crypto assets? And if so, what aspect is particularly important for you?
Okay, so there's private crypto and then all the central bank digital currency stuff. I have to say my view on private crypto, I'm scared by that stuff. I think if you want to look for a shadow banking, a reincarnation of shadow banking, that's precisely that. Okay, I mean, you know, as I said many times on this call before, you know, the concept that I, you know, nabbed and I guess called shadow banking in 2010, and the concept that, you know, Perry helped me crystallize in my mind with this, you know, shadow banking is money market funding of capital market lending, you know, that's shadow banking to me. Then, you know, the world kind of started to call shadow banking all the direct lending that, you know, an asset manager would do to a corporation, whether there is money market funding involved or not, you know, they call it shadow banking. I don't think that should qualify shadow banking as it's just, you know, direct lending. Now, when you look at the crypto stuff, I mean, I don't know what that funds, but I mean, people look at crypto as if it was money, okay? And there, you know, there's not just Bitcoin anymore, but a bunch of other venues and other, you know, cryptocurrencies. I mean, it's a bit funny because, you know, in my current seat, I follow money markets. And so, you know, that has very well-defined institutional boundaries as to funding markets and whatnot. So that's money to me. All this other stuff, I mean, it's crazy, but I mean, you can read about cryptocurrencies getting repoed, you know, at an interest rate of 6% just to convert cryptocurrencies into dollars, you know, so that you can actually exercise your purchasing power in the real world. And so people don't want to get rid of their cryptocurrency because it appreciates all the time in value. And so you're willing to pay 6% interest to get dollars temporarily to do whatever you need to do. And then, you know, you just, you know, hold on to your crypto stuff. I mean, if that's not Minsky, I don't know what is. I mean, basically, you know, I guess that's the speculative unit in the Minsky hierarchy. But, you know, anything that appreciates, I mean, the value of a cryptocurrency, you really want to think about as, I guess, an exchange rate, right? I mean, the value of money should not fluctuate up and down to the extent that the value of these cryptocurrencies does. And so the value of cryptocurrencies is expressed in US dollars. And so that just tells you that the Bitcoin to US dollar exchange rate is as volatile as it is. You know, it's just phenomenal. So I think, and, you know, we have no idea, you know, what's behind Bitcoin. We know that it has to be mined and it costs a lot of energy to mine it. But I'm amazed that central banks have let the crypto issue get to the proportions that it did. And I guess I'm always, just one second, guys. Yes. Okay, so that's one thing, that the central banks didn't stop it, and so it grew organically to the point that it grew. So I find that amazing. I mean, you know, money is a public-private partnership. Crypto is purely private money. And I think it's a lot less understandable, to me at least, and a lot less transparent than shadow banking was back in the day. So that's one set of observations. Then there's the central bank digital currency stuff, which I don't know exactly where that came from, and I tell you still that I still wonder why exactly we need it, and so I don't know the push and pull. Maybe this was the response of the central banks to kind of sanitize the private crypto stuff that's out there. Maybe this is something that central banks have put on the agenda, chiefly in negative interest rate jurisdictions, to ensure that there is the transmission to the retail depositor of negative interest rates, right? Because the banking system didn't do that transmission. I mean, deposits yield zero everywhere, and you know, the deposit rates at central banks are negative, so that pass-through didn't work. And so maybe that's why they are doing it. But why exactly we need to digitize the relationship between the holder of currencies and central banks, I really don't understand. You know, I think it's hugely it's a very big and existential question for the banking system, if you will, because, you know, as Perry has taught all of us, you know, the banking system is, the payment system is a credit system, right? And so I also don't know how the central bank digital currencies kind of fit in with that, because if everybody on the street is going to have an account at the central bank, and you should be able to freely move between bank deposits and central bank deposits, you know, how is that whole thing going to work? Like, is there going to be a credit element to my, you know, private account at the Fed or whatever the vision is? The third thing I will also tell you is that, you know, when it comes to Basel III, I think the implications of this for the entire funding strategy of banks is huge, because when you look at the spectrum of funding options that a bank has, retail deposits and, you know, the so-called corporate operating deposits are all the most valuable types of funding for a bank. So then if we have central bank digital currencies and I can move my cash from JP Morgan to the Fed, you know, JP Morgan is going to lose my retail funding and everybody else's retail funding. And then JP Morgan is going to have a funding hole, which then they are going to have to fill by going back to the central bank and get funding from them. And so then you just basically replace the system that we have currently, where everybody keeps money at a bank to everybody keeps money at a central bank, and then a central bank funds the banks. And so if you just did that, but exactly, I mean, the one question I always ask all these presenters from various walks of life about cryptocurrencies is, what exactly is the problem you're trying to solve by creating central bank digital currencies? Like, what is wrong with the setup that we have currently that needs fixing?
Oh,
okay.
And so
I never get a straight answer, and I never get a straight answer for that. But I'm just baffled by the dynamics here. So
okay, Perry suggested maybe it's an elegant way to grant access to the central bank's balance sheets to other institutional investors, non-banks.
Just give me 1 second. So you're saying Perry says that this would be a way to give access to the central bank's balance sheet to other institutional investors.
Yes,
right?
Yes. At least that was an idea. I don't want to put it into his mouth.
Well, I mean, look, money funds have access to it because you have the reverse repo facility. Foreign central banks have access to other central banks because they have their own foreign repo pool. You know, do we? I mean, I don't know. Maybe sure. I mean, for corporate treasurers, we can open this up. But I mean, there is all sorts of. Just give me 1 second. Let me deal with the situation that I have, and then I will be back. But someone keeps texting me, so just 1 second.
All right, in this short intermission, perhaps then I'll do some housekeeping for the Q&A. So after Zoltán's interview is over, we'll first have Alex posing his question, and then Jay will ask a question, followed by Tatiana. And if I may impose, I see we have the former governor of the Hungarian Central Bank on the call. And so if Georgi Soranyi would like to pose a question or weigh in on the discussion, that would be very welcome.
Yeah,
and so,
I'm back. I'm back, by the way, so sorry about that.
No worries. Carry on, Zoltán. Thank you.
So yes, maybe we could start with the questions, and then maybe let's take 2 or 3 questions in, and then I can start answering those.
Fantastic. So Alex, Jay, and Tatiana first up.
Yeah, so I found that really interesting that PNC Bank took more stimulus deposits than any of the big banks because some of these GSIB restrictions, that kind of thing. So my question is, would it be accurate to say that the GSIB constraints help spread out the too big to failness across more institutions? And does that ultimately lead to the creation of more GSIBs?
Okay, so just one second. Should we take more questions? And then I'll answer 3 questions in one shot. Why don't you do that?
Fantastic. Jay and Tatiana, you can go next.
Hi, Zoltán, it's Jay. It's really good to hear you, and it's a really great presentation. And I agree with many of the points you made. Just a very general question. I'm just wondering about the Biden infrastructure investment plan, and more specifically also Yellen's corporate or call for a corporate minimum tax globally. Do you think that trickles down specifically to the dealer system? Are there any implications you expect? So in the money markets directly that we should watch out for?
Okay, and then one more.
Hello, Zoltán. My name is Tatiana. I'm a student here in Brazil, and on the discussions of CDBCs, you were talking about how this grew, this discussion on CDBCs and cryptos. I was just wondering if the discussion around Libra, and now called DEM, like Mario cited in the chat, has put forward this discussion on in the BIS, because I think it's very important to analyze how these digital platforms has changed our life, and even how we think about transactions nowadays. So I think Facebook has, in my opinion, had this force in some of the speeches that I have seen and read.
But your point is that can you can you say that last bit again, and also what the question is?
Yeah, the question is mainly if these discussions around CDBCs were mainly because of these digital platforms, Facebook and Libra, and now they're calling this I don't know what the name is, but it's called DEM now. It's not a crypto, it's not a CDBC, I forgot what it's, stable coin. It's a stable coin. Yeah. So I think this has like, how can I say, really pushed the debate towards CDBCs and central banks, and mainly the BIS working papers around that. That's the question, and that's also analysis of my own, but I would like to know what your impression is.
Right. Okay. So let's start with the first question, which was a good question. I mean, look, I think the fact that PNC is growing is, I mean, not PNC in specific, but the fact that the regional banks are growing is a good thing. I mean, when you think about the GSIBs, it's a relative idea, right? I mean, you know, finance is always going to be hierarchical, as Perry says. So, you know, JP Morgan is always going to be at the top, and then everybody else is going to be below. But how far atop that bank is relative to others, that's what GSIB is policing, basically, right? And so if you have a constraint on one bank, others are going to get a little bit bigger. But again, you know, maybe a way to put it is exactly what you have asked. You know, instead of having one systemic institution, you will have other bigger systemic institutions. But I mean, that's just going to level the playing field. I mean, so the way some of these things can play out, for example, is, you know, JP Morgan was in a similar situation a couple of years ago, and they had to get out of the repo clearing business. And, you know, that's how, you know, Boney became the sole repo clearer, simply because, you know, JP Morgan's GSIB score didn't allow for that business line to be housed within the bank. And so they got out of that business, and Boney took on more of that activity. And so, you know, the activity in the system just kind of gets distributed, and so nobody is too systemic, and so that's the way it's working. Now, when you kind of look at the regional banks, I mean, I think that's just a healthy development, because, you know, you're spreading all these deposits and all this liquidity a bit more evenly. And so when you will have the upswing and the economy is back on track and lending resumes, you know, there's going to be a lot more lending that will be done by these regional banks. And so, you know, I think anything that distributes funding and liquidity and risks across the system, as opposed to concentrates them, is a good thing. So I guess that's the answer. That's the answer to that. Is that more or less satisfy your question?
Yeah, that makes sense, and that's consistent with everything
Yeah.
you were saying before. I'm just trying to wrap my head around all
Yeah.
this.
Yeah, I mean, by definition, you know, I mean, too big to fail is like, usually it's like one or two institutions, right? So if you kind of limit that process getting too big to fail, and, you know, risks are spread across.
Right. If everybody's too big to fail, then maybe nobody's too big to fail. That kind of thing.
Well, I don't know about that, but certainly I think, you know, by design, you know, the GSIB aspect of Basel III is doing precisely what it was designed to do. So that's that. The second question was about the fiscal stimulus, infrastructure, and the tax hikes, right? What was the question there precisely?
Zoltán, my question was on the fact that we have all these excess reserves floating around the system that you mentioned many times. What does it do exactly with that particular aspect? I'm just wondering, is there any major shifts you're expecting in the dealer system, in the money markets, based on these two major pieces of the new plans that Yellen and Biden are proposing?
Right. This is Jay.
Yeah, that's me, Zoltán. It's good to see you.
Hey, Jay. What's up? I recognize the voice. I recognize the voice from among 100 people.
Okay, good.
All right. Well, look, I think this. So the way you think about all the fiscal stimulus that's coming down the pipe. So there's two things there. I mean, someone is going to have to buy those bonds, and that someone is going to be some real money guy that has the cash, or some guy that needs financing or hedging or whatever on the margin. There's definitely one thing for sure, which is that there is so much liquidity in the system that regardless of how much bonds we put in the system from here, I mean, there is so much money in the system that it's going to be able to settle quite easily, you know. So the auctions and the settlement process and the money moving around, that's not going to be a problem, at least not for the foreseeable future. I mean, things can get out of balance over time, but for now, there's a lot of liquidity. The big question now is, I mean, I'll tell you the one thing in the markets is that everybody is kind of looking for, you always need a marginal buyer, okay? And so those marginal buyers historically, and I guess by design, they can only be the banks, the bank portfolios, not the dealers. Dealers just move stuff around. The bank portfolios, the relative value hedge funds, and the foreign real money community that buys stuff on an FX hedged basis. So what we know is that, you know, the banks are probably not going to buy as much this year as they did last year, because they can now buy back stock. And so, they are going to kind of make that decision as to buy or not. And if they buy back stock, they basically throw away balance sheet capacity and they are not going to buy treasuries. The relative value hedge fund community, I guess, the basis opportunities are just not good enough for them to step in at the moment. So everybody waits for the foreign investors to step in. So these would be your Japanese life insurance companies and pension funds, and the same types of accounts from Scandinavia and Switzerland and continental Europe, wherever you have negative interest rates. And so the idea there is that, on an FX hedged basis, the yields in the US look now extremely attractive, just as attractive as the yields were back in 2015 and 2016. So, if you make 0% in Japan by buying a 10-year Japanese government bond, you can make, close to 1% by buying a 10-year treasury, and, more than roughly 1.5% if you buy a 10-year treasury and you hedge it back to yen. So that's a meaningful yield pickup. Now, the one thing that goes in favor of doing that trade is that from a funding perspective, right, when you buy these treasuries, you roll the hedges on them every 3 months. So you need to ensure that when you roll these hedges, there is going to be the liquidity and the prices are not going to move against you. And that's just a function of US dollar liquidity in the system. And there's absolutely no shortage of liquidity on that front. There's also, balance sheet and better pipes in the system these days than there were back in 2015, 2016. So the funding bit is not what worries you. What worries you is that when you look at 2015, 2016, back then the funding bit was a problem. This year it's not. This time it's not. But back then the supply was very tepid. I mean, in 2 years we issued something like, I forget the exact number, but the trajectory of U.S. Treasury issuance was pretty flat. Right now they are exponentially going up. And so the issue is that none of these foreign hedge buyers like to catch a falling knife, and they like to buy into established trading ranges. And so it looks like on the 10-year we are now trading between 1.75 and 170. So maybe we are going to settle down at the 1.7% range. But, there is risks that this extra supply and, the inflation dynamics and, maybe the Fed is not as committed to keeping rates as low as they indicate, maybe these yields are going to move to 2%, 2.5%. So I guess the issue with, how are we going to finance all this fiscal stimulus is that people want to know how high yields can move before they start harvesting these slopes. But other than that, everything is kind of aligned for these slopes to be harvested, except for the asset that you buy. You don't know if it's going to trade flat from here, or if it's going to sell down, or if it's going to rally. And so, the one I guess the big question in fixed income markets at the moment is what's going to be that catalyst that's going to bring in a lot of these investors from the sidelines to start buying treasuries on a hedged basis, because they are going to be clearly the investor base that's going to absorb the bulk of supply this year. Is the Fed going to have to, communicate things such that people have a confidence as to the upper limit of how high yields can go? Even there, things are quite open for debate, right? Because what this recovery is nothing like the recovery was like back in 2008. Back then, we had a very balance sheet sensitive recovery where the Fed basically had no appetite for yields to move higher. This time around, the recovery is completely, shut down and reopening driven, and it's largely services, and there is no balance sheet sensitivity in the system whatsoever. So the general consensus in the market is that the Fed's pain threshold as to how high it can let yields go is quite high. And so that's another thing that keeps these investors on the sideline. So I myself, I don't particularly have a very strong view as to what's going to be the catalyst that's going to bring in these FX hedge buyers. It's clear that the slope itself and the carry one can have is it's a necessary condition, but it's not a sufficient condition. So I think maybe some indication from the Fed that they would do some duration extension of their purchases, or the Treasury kind of reorienting issuance from the back end more to the belly to kind of calm down the longer end of the curve. I mean, maybe some of those things are going to be necessary to bring in from the sidelines these foreign investors. So everything is in place. It's just that people don't know how high yields can back up from here. And then I guess the other interesting thing to watch from here is the Japanese year-end turn just ended on March 31st. So Japan is starting a new fiscal year. So that should kind of make them more willing to buy on the margin too. But again, whether that's going to materialize or if they are going to stay on the sidelines because you don't know how high yields can back up from here, that's just something that they will see. So that's the answer there. I hope that answers your question.
Thanks, Zoltán. Appreciate it.
Yeah. And then the Libra question. Again, I'm sorry, what was the question there again?
It's just your opinion if you think that the Libra from Facebook, now DM, has pushed the debate to CBDCs and central banks. Of course, there are other factors, but I think that it's an institutional factor that I would like to know your opinion about.
No, I don't think that it has pushed, and I guess just maybe a final thought on that. I think people conflate, or maybe I don't know enough about this, and maybe I'm kind of like the shadow banking dinosaur that didn't catch the new trend. I think when people talk about technology and payments and banking, they don't understand banking or the nature of it. The stuff that Perry talks about. How it's a credit system and, all the book entries. I mean, I think it's one thing to come up with these fancy interfaces, but to kind of redesign a financial system around these, stable coin ideas just because you're a tech company and you have all these ideas. Again, I think this is kind of muddling the debate. It's not. I'm not sure that. I mean, I've been on some panels and I have been involved in conversations with some of these crypto types. But again, I just don't articulated kind of what they are trying to achieve and why the existing system cannot achieve what these cryptocurrencies are trying to achieve. I think there is a strong distinction between blockchain and the applicability of that in the accounting world and how things can get revolutionized by that and the distributed ledger and whatnot. But that's just a book entry thing. But I don't think that Libra getting renamed this way or that way has pushed the envelope either way. And frankly, I think the central bank digital currency. I mean, I don't know if there's any central bankers on the call, but I think a manifesto, if you will, on what the problem is and what we are trying to solve, I think that would help. Because to me, it feels like at the moment, you see, the technology world do their own cryptocurrencies, and then, China doing CBDC there. And so trying to do something similar just because there's all this other stuff happening. But exactly why are we doing this and why do we need it? What is the underlying problem that we are trying to solve? I think that would be tremendous value added if there was a very clear there was a very clear, short paper on that. I mean, I tried to read some of these papers that are out there from, the BIS, and so there's all these. There's a lot there, but again, what are we trying to solve? I still don't understand.
Okay, but yeah, well, sure. It's just that I don't know. It's for me, it's a little problematic to have a stable coin, even if it's digital, on with Facebook, because it's a private company. So I think that would be a very important factor just to central banks to think about the possibility of CDBCs, because it is a big private company that has a lot of power in today's world. It is a digital worldwide platform, and people, it's just that's what I'm thinking about mainly.
Yes, no, look, I know, I fully agree with you, but again, as I said before, I think, money is a public-private partnership. And just because some technology companies think that they can create these stable coins, I think central banks have a role to play. And I think they do have the ability to draw the line and draw a perimeter around what is banking and what is not, what is money and what is not. And I think we should be very clear about, I mean, it's a big word, but banks do have a monopoly on money creation, and that monopoly has a price which is very intrusive and hands-on regulation. And that's that. And I think that should be the perimeter that where you draw the line on money and everything else. And I think we should not be blurring those boundaries. We should not be blurring those boundaries. So that's where I'm at.
Thank you, Zoltán.
Yes.
Thank you very much.
If I may, we actually do. So Zoltán asked if there are any central bankers who might want to weigh in on what he just said, and we actually do have a central banker. So maybe Georgi Sarani, if you would like to make a comment, I think this might be a good moment to give your thoughts.
Thank you so much. Indeed, I didn't want to pose any question to Zoltán. However, I would like to capitalize on this generous opportunity. Let me have one brief comment on the digital currency, central bank digital currency. I'm fully in line what Zoltán was explaining regarding the essence of this instrument. If I may add one argument for, not a strong one, but this is an argument for the digital currency. Many emphasize the need for a super safe asset, and the central bank digital currency can be perceived as a super safe asset with all the problems you have explaining to us. Now, I really would like to capitalize on having you here. And I have some assumption, but I'd be very much interested in your view about the following. Sentiment as far as the inflation is concerned has shifted unquestionably upward. And there is a striking difference in the money supply dynamics between the post-depression period, financial depression period, and the current one. Back to 2008, 2009, the money supply, the broad money, has hardly grew at all. On the contrary, in the post-pandemic situation, the broad money aggregates jumped to the sky, if I may say so. What is your explanation why it has happened? Why we experience this striking difference in the reaction of the system? The monetary base grew in both cases substantially, whereas the broad money didn't after the 2008-2009 crisis. How do you see that?
Well, I think, I mean, I haven't really dug deep into it, but I think one important difference between the two is that here we had QE with fiscal stimulus, and back then you had QE with not much fiscal stimulus. So you basically had back then QE aimed at, you know, the portfolio balance channel, okay, where basically all the money that the Fed has put into the system was greasing bond issuance and all sorts of, you know, balance sheet arbitrage that the system ended up doing. I mean, if you think about the order of things back then, I mean, you know, the first waves of QE, you know, ended up in emerging markets. So there's a lot of emerging market countries that borrowed in US dollars. Then, you know, famously, you know, China kind of told its corporations to get out of that trade, and so you know, that came and went. Then a lot of corporations basically tapped into all the QE money that was put into the system by issuing debt, buying back their stock, paying dividends, stuff like that, right? So relatively little ended up in the real economy, so to speak. This time around, you know, the whole stimulus is aimed at the real economy. And so, you know, that link between QE and then fiscal stimulus, and then the fiscal stimulus being destined, you know, to go out as stimulus checks to ordinary households, and households getting more deposits in the banking system. I think that's a very important feature of this episode of QE versus that episode of QE. I don't quite know. Actually, it's probably worth for me to look into why exactly that QE didn't show up as forcefully in the monetary aggregates back then. But I think the reasons why it's showing up aggressively this time around is pretty obvious, because all this money is going into the real economy. And again, I mean, if you just look at the fact that, you know, stimulus checks since the pandemic started have probably amounted to $1 trillion, you know, that speaks volumes about. I mean, that I would say is the single most important difference between QE4 and the earlier episodes of QE.
Thank you.
Yeah.
Great. Fantastic. Thank you, Zoltán, and thank you, Mr. Sarani. I'll read out the next question. So we'll have a last round of questions. And so the next question is from Chris Rimmer, and he asked, could the problem being addressed by CBDCs be just about central tracking of money use, as well as applying negative interest rates? And so the next question is then from Win, and then directly after that we'll have Shengbi, and that will be the last round of questions.
Well, I think, I mean, initially when the whole CBDC, I guess, research effort started at these central banks, I mean, that was my initial reaction, that probably the reason why we are thinking about all this is because we want to ensure that negative interest rates actually apply as intended. Because as I said, you know, the banking systems in Europe and in Japan didn't really impose negative interest rates on depositors, right? So that tax through which negative interest rates are supposed to work didn't quite work. But then again, you know, like the BOJ is not really as excited about you know, digital currencies as other jurisdictions. So maybe, and then I think, you know, China started to do its own digital currency, which I guess, you know, that's coming from an angle of, you know, if you want to create a rival to the dollar, you kind of need to do that from the ground up. And so, you know, the dollar has Eurodollar market, and it has SWIFT, and it has all these networks around it. And so how do you upend that network if not by creating a new network? And since we are living in this era, let's just do a digital version of it. And so I think that was another impetus. I think a lot of it is probably driven by the China project. And so you're just, you know, it feels like you're trying to catch up with with what's happening there. But again, it's all really muddled. I don't think that there is anything wrong with the current system. And you know, the super safe asset that you mentioned just before. I mean, I really don't understand why we need a super safe asset, because I think, you know, treasury securities are perfectly super safe. Currency in a bank deposit is perfectly super safe. Money in a government money fund is perfectly super safe. And so, you know, if you're worried about, I don't know, cyber, I mean, you know, it's not like central banks haven't been hacked before, you know, and so I just don't know why having a different form of an asset would enhance the super safeness of that asset relative to you know, the safety of a bank deposit or anything like that. So I think probably the China factor and China building basically its own digital, you know, monetary system. I think that's probably a very strong push. But I guess there, you know, you're just building something from the ground up, and so it's a new project, and yeah.
So Chris has asked to clarify, specifically related to tracking the use of money when all the transactions are within the central bank. Yes.
Well, you know, there is that too, but again, you can do that, but are you going to create a digital currency just to do that? I mean, if you wanted to track all the money movements because you wanted to have some real-time GDP or whatnot, I mean, you know, you can, as the government or as the statistical agency of the U.S. or any other government, you can say to Amazon, you know, please give me all just, you know, be strategic about it. I mean, banks that run large credit card portfolios already know real-time data of, you know, what's happening in terms of demand for services and demand for retail goods. I mean, some large banks use, you know, the real-time credit card portfolio data that they see to forecast, you know, retail sales and all this stuff, and, you know, trade around that information that their bank generates. And so if somebody wanted to do this just to aggregate, you know, real-time economic data to have, I don't know, real-time retail sales or real-time GDP, I mean, just pick, you know, the 5 largest banks and ask them to submit their data in some standardized form to the Bureau of Labor Statistics, and ask the same thing from Amazon, and you know, you will have a pretty good chance of coming up with something real time. Do we need to redesign the financial system to do that? I really don't think so. I really don't think so.
Thank you, Zoltán. And now Win.
Hi, thanks for the talk, Zoltán. My question was going back to the role of FX swaps. You mentioned that they're, you know, increasingly important part of market making and bank activity. So I guess I was wondering, could you kind of walk us through a little bit of how they're used in market making and why you think, or what you think the drivers are for their kind of growing importance, and, you know, potentially what the kind of policy implications of that might be?
Well, the policy, I mean, you know, policy implications, you know, I don't know. I mean, the FX swap market has been growing, you know, quite a lot since the great financial crisis, right? So you're looking at, you know, more than 10 years of growth under the QE era. I mean, again, it's just, you know, bonds became cash. I mean, that's what QE does. And bonds are becoming cash in a bunch of jurisdictions. So if you are, you know, in Europe, or if you're in Japan and your bond yields are 0, but bond yields are better in the US, then you will buy bonds in the US, but you still want to have your currency risk in euros and yen. So you hedge it all back to euros and yen. And so effectively what that means is that for you to buy your bonds in the US, you just swap yen and euros for dollars. You roll that swap every 3 months, And so you basically buy a US dollar bond and you have an economic exposure in yen and in yen and euros. And so when you kind of look at the actual flows that are happening, it's just, the banks are gigantic marginal lenders in the FX swap market. I mean, the FX swap market is a market that's controlled and it happens on the balance sheet of banks. And, when a bank has to lend on the margin in the FX swap market because, the prices are moving and there's an air pocket or something like that, effectively what the banks do is they swap a deposit at the Fed for a deposit at the BOJ. Okay, so basically when you look at, large US banks deposits at foreign central banks, that tells you a gigantic inventory position in FX swaps. You look at JP Morgan's deposits at other central banks, it's $200 billion. You look at JP Morgan's treasury inventory, it's like $60 billion. I mean, that's the thing I'm trying to say, that, looking at this treasury inventory bit and seeing it go down over the past decade, it's a bit like you're missing the point because pre-great financial crisis, you guys know that everything was about bonds, right? And everything was repoed on the margin because bonds and money were the same. Fast forward to today, after trillions and trillions of dollars of QE in Japan and in Europe and in the US, a lot of those bonds have been monetized. So the margin on the margin, the trading in things is happening in terms of cash. And, the FX swap market is cash for cash trading, right? Where you lend dollars and you get cash collateral in yen and euros. And so, depending on whether you're a bank or a dealer, you keep it at a foreign central bank or you buy foreign bills with it. But, that's where the bulk of inventories are in the system these days. It's not treasuries. So that's that. The issue is that when it comes to measuring these things, this FR 2004 survey that comes out every week, that measures dealer inventories. These are U.S. dealers active in the U.S. and their U.S. books only, and there's no equivalent for their global activities. Okay, and things get further muddled by the fact that some of the FX swap lending at some banks is done in the bank, at others it's done in the dealer. It's kind of hard to track these other inventories, but that's where the bulk of money dealing is these days. So that's just something to keep in mind. I think sometimes these statistics, they distort the thinking because you're looking at one thing, but then you kind of miss the picture around it. And oftentimes these other FX swaps are very purely mapped and quantified in government statistics. So you have to go to. I mean, I do this in my work. When I talk about the FX swap market, I look at this bank and that bank and how much they have at this central bank and that central bank. I mean, that's what you need to do, but it's a lot of kind of bottom-up legwork because there is no central warehouse for data on this. And so, those are the real inventory. Those are the real inventory positions. And by the way, now we are going to go into, when you look at dealer inventories in the U.S. over the past 5 years, dealer inventories were lean between 2015 and 2017, and in 18 and 19, dealer inventories ran up because, there was a bond basis, and that's where the action was on the margin, right? Between 2015 and 2017, the action was in the FX swap market. And as I said, those inventories are not being measured. Right now, the pendulum is swinging again away from U.S. treasuries, long treasuries, short the future to harvest the basis. And so that's why the inventory numbers are coming down. And, this other inventory build that we will have in the FX swap market once the Japanese come back into the market, that's going to go up again. But again, we're just not going to see that we're just not going to see it in the numbers. So perceptions, this is like, it's a bit like those drawings, you know, where like, do you see an old woman on the drawing or a young girl? Like I forget. It's one of those tricky drawings. So some people see this and some people see that, but you know, these statistics and the charts can be deceiving if you just narrow, if you focus on the image narrowly without thinking about the broader context. Now, you know, I'm just saying this because, you know, a part of the treasury market's liquidity in large part depends on the dealer's ability and willingness to build these FX swap books such that they can facilitate the hedges for the Japanese life insurance companies that want to buy treasuries. You know, if that process gets gummed up, the treasury market doesn't clear as well as it otherwise would. So, you know, it's not as simple as, you know, you need to deal with the SLR here because the dealer inventories of treasuries are going down. And by the way, when it comes to building these FX swap books, you know, SLR is one thing there and GSIB is another. And again, you know, if you have constraints at the Americans, all that activity is going to go to the French dealers and the Canadian dealers and all that. So maybe let's do, we have I have 3 more minutes, and then at 11:30 I will have to go.
Fantastic. Can we do the last question, which is from Shengbi?
Hello, I have a question on SDR. I think one of the major—
On the what? I'm sorry, on the what?
SDR, IMF's SDR.
Oh, SDR, okay.
Yeah, I think it could be one of the major market moving events in next maybe a few quarters. The expansion of SDR has been endorsed by Biden administration, as well as Yellen has been strongly supporting it, despite Republicans' objection. I can see almost all countries supporting that. So within the IMF hierarchy, of course, the further away you are from the top, the more likely you are going to support it, to benefit from that financially or economically. But US is one of the case where you can see why US may not be supporting that, because this could really change the global system in some sort of way. So I want to, of course, this can really, the question can be expanded really tremendously, but I really want to get your view on how you see that, the SDR's expansion, major expansion in the next couple of quarters.
Well, to be frank, I don't know nothing about that news item, so I haven't really been focused on what's happening there or what the aim is. I'll probably have to disappoint you. I don't know what to answer there because I don't follow the SDR. But I think Perry Mehrling would be perfect candidate for you to ask that, because his current focus is all about the dollar and the SDR and whatnot. So unfortunately, I don't know what to say there.
Okay, thank you.
Yeah, sure.
That's all right. Thank you so much, Zoltán, for your time. As usual, you're incredibly generous with us with your time, and so we really appreciate all your insights and for taking all these questions. Also, thank you to Christoph for your very pertinent questions, and to the audience for a lively discussion. I think we'll cap it here for today. Hopefully we'll have Zoltán back again. So I've posted in the chat that there are a few upcoming YSI events for you to take note of that'll be happening tomorrow. So please do register for those, and please do engage in your YSI working group's mandate as well over the next week as well. But for now, that is everything. And so thank you, Zoltán, thank you, Christoph, and thank you to everyone. Have a good day.
Okay, and thank you for Adam too for setting it up, because he was the one who reached out. So thank you very much for having me, and I'll talk to you guys later this year, hopefully.
Fantastic. Thank you so much.
Okay.
Take care.
Thank
Bye.
you. Bye-bye.
Yes, thank you.